Multiple time frame analysis, MTFA. The existence of an analysis method using several time frames is enough to help traders to find strong support and resistance levels. In this paper, we will discuss what multiple time frame analysis is, how to choose the right period and how to combine it. Multiple time frame analysis, MTFA, is a method of technical analysis by reading charts involving several time frames, TF, for the same currency pair. There is no standard limit on how many TFs that can be used, but there are several considerations that need attention. Before discussing further, we remind you again that the time frame, TF, is the time limit used on the MT4-MT5 trading platform charts. TF can have many choices. In the world of forex, there are several TFs from 1 minute, M1, 5 minutes, M5, 15 minutes, M15, 1 hour, H1, 4 hours, H4, and so on. For example, TF-M5 means the formation of a line/candle chart occurs every 5 minutes. In 5 minutes only one candle is formed. This time difference will focus on different market emotions at different times. TF, D1, or 1 day, is long-term in nature because each candlestick is formed every 1 day. So, for traders who use market closes confirmation, they must wait 1 day. TF, which is smaller than H4, is more short-term. Even if it reaches TF, M5, and TF, M1, trading will change to what is known as scalping, where this trading style prioritizes the speed of entry and exit of trades and small but large profits. Even overseas, some are even faster, up to a nanosecond, by using an automatic computer to enter and exit positions. This is known as high-frequency trading or using multiple TFs in trading has 3 advantages. First, each TF shows the emotion of the market where the observation TF is viewed. The bullish bias on TF, D1, means that the market tries to go up every day. But in 1 day there are 24 hours and every hour, the market's emotions can change. Likewise, every hour consists of a collection of minutes which of course has its own character in each minute. Knowing the emotions of the market at any time can help make entry or exit decisions. Second, looking at several TFs can help traders match their trading style to the character of each trader. Traders who can make stable profits generally have a trading style that matches the character of the trader himself. Generally, without a match between the trading style and the trader's character, profit stability cannot be achieved. A trader who has the character of quickly making decisions and acting, so when trading using slow TF readings it will make this trader bored, even make fingers itchy or trigger happy. On the other hand, other traders who need time to make decisions and act will be overwhelmed when faced with fast TFs. Matching the way of trading and the character of this trader is one of the main factors for the success of a trader. Thirdly, TF divides the market by time, giving traders the opportunity to time their own trades. Because in the end, trading is just a part of a trader's life. Many people think that to be a successful trader you must keep monitoring the market, looking at charts, being in front of the computer and watching price movements. That's all very untrue. On the contrary, successful traders generally have certain times where they usually trade. Warren Buffett once said he only looks at and reviews his positions once a year. Maybe more often. But the bottom line is Buffett has a trading time that he likes and suits his trading style. This wide variety of TFs will give traders the opportunity to choose the most suitable time for each trader. For example, JSX stock day traders can focus on the first 3 hours where volatility is high. Or the forex trader chooses 2 p.m. to start trading because the European forex market is open. Thus, traders will be able to be more strategic in their trading because the time allotted for each of their trades is always maximum. TF trading has one drawback which is caused by the difference in emotions between each TF. This means that if a trader starts to look at several TFs, which have their own emotional characteristics, then a difference in bias will be seen. Maybe TF-D1 has a bearish bias, but when you look at TF-H1 the bias looks bullish. Generally, traders, especially beginners, get confused and don't know what entry to make. What's worse is if the trader then follows TF-D1 and sells entry, but then looks at TF-H1 which is still going up, which causes traders to buy again regardless of the possibility of a trend on TF-D1. This error is more visible in forex because traders can trade both ways. This drawback brings us to the cardinal rule of MTFA trading. If a trader makes a trade based on one of the TFs, then the exit from that trade must also be determined based on the same TF. This means that if we enter based on the price movement on the H1 TF, then the decision to exit must also be based on the price movement on the H1 TF. Most of the mistakes that occur are caused by traders switching TFs between entries and exits. By looking at price movement across multiple TFs, we can become better traders and better able to monitor the true emotions of the market. Looking at DFH1 provides an opportunity for long-term traders who see entry opportunities on TFD1 to get a better price. Likewise, looking at DFD1 helps short-term traders to be on guard in their trades that are based on TFH1 but counter-trend with DFD1. According to experience, using three different DF is enough. If too few TFs are used, the information to be obtained may not be clear, but conversely, if there are too many, it can be too late to decide. So, in choosing which DF to use as a reference, you must adjust the style of each trader. For example, a scalping trader with a fast character in his transactions can use DFM15, TFH1, and TFH4. For daily traders, he can use TFH1, TFH4, TFD1, and so on. The medium, mid, TF should first be set as a benchmark for how long, on average, the transaction will be left open. Then look at the short, TF and then confirm a clearer trending movement on the larger, long, DF. For example, scalping traders use 3 DFs. Namely, M15, we call TF short, M30, we call TF medium, we call H1 TF long. It is very important to choose the right DF. A long-term trader who usually keeps his position open for a long time, for example a week, should not use the TF combination for scalping above. It would be better to use other combinations, for example DFH4, daily, D1, and weekly, W1. TF long with the MTFA method like the example above. It's better to start with a long-term TF, long TF. By observing the long TF, you will be able to find the most dominant trend. To open a position, don't use long TF as a signal. Long TF is only used to determine general trend direction, so positions opened later must be in the same direction as the trend seen on this long DF. But that doesn't mean you can open a position opposite the trend on long DF, but you should always remember the concept trend is a friend. Positions that are opposite to the general trend will have less chance of success than positions that are in the same direction as the general trend. M15, we call TF short, MH1, we call TF medium, we call H4 TF long. It is very important to choose the right DF. A long-term trader who usually keeps his position open for a long time, for example a week, should not use the TF combination for scalping above. It would be better to use other combinations, for example DFH4, daily, D1, and weekly, W1. TF long with the MTFA method like the example above. It's better to start with a long-term TF, long TF. By observing the long TF, you will be able to find the most dominant trend. To open a position, don't use long TF as a signal. Long TF is only used to determine general trend direction, so positions opened later must be in the same direction as the trend seen on this long DF. But that doesn't mean you can open a position opposite the trend on long DF, but you should always remember the concept trend is a friend. Positions that are opposite to the general trend will have less chance of success than positions that are in the same direction as the general trend. TF medium on TF medium you will see the twists and turns of movement more clearly than on DF long. It is on TF medium that you can later determine when to open a position. The instructions in DF medium will be detailed again in a lower DF, namely the development of trading techniques, often on TF medium. You will get early instructions regarding a possible reversal. TF short, it is on this DF that later you must determine the entry signal, buy or sell, because the fluctuations that occur can be seen more clearly so that a trader will be able to take a better entry level later. But remember that the signal that appears on this DF must be in the same direction as the trend that has been shown on the larger DF. Combining 3 DF combinations to analyze a currency pair is expected to make it easier for traders to find the best entry-level clues. Notice the quotation marks around the word best. There is no best level, because no one will ever know when the price will stop at a certain level. But we can try to find the cheapest possible price if we want to buy, or the most expensive possible if we want to sell. So, the term best is here only to try to prevent us from making decisions too quickly or too late. With MTFA, the analysis is carried out in a top-down manner. It means that traders must look at the biggest DF first, to see the trend and then gradually go down to the smaller DF. For example, if TF long shows an uptrend but DF medium and DF short show a downtrend, then traders need to be careful if they want to open short positions. Always remember that trend is a friend. In this case, TF long is the benchmark for the trend. So, as a consideration, you should wait until the smaller DF confirms the trend on the larger DF. Thank you so much for watching. Good luck to all of us. Don't forget to follow and support us by liking, commenting, sharing and turning on the bell, so that many more people can make maximum profit from trading.